Thanks for joining us for the Executive Series today. I'm talking to John McBain, who is the CEO of Centuria Capital. John, great to talk to you.
Thanks for having me.
Now, for people who aren't familiar with your organisation, tell us exactly what it is that you do.
So we're a specialist fund manager. We were formed in 1998. We have $3.7 billion under management, and that's spread across a range of property funds, and also we have an investment bond division.
Okay, so you've just undertaken a pretty substantial acquisition. You've bought the platform of 360 that in relation to the real estate business, and that's been a pretty transformative outcome for you.
Yeah, so we had a mature business that was trading very profitably, listed on the stock exchange, but with a market capitalisation of sub 100 million, even though we were growing it very aggressively with property fund acquisitions, index inclusion and wider acceptance in the equity markets, greater liquidity was a long way off for us. So finding a platform that was complementary was a pretty high on our list of targets.
So in terms of the asset mix, does that complement your business exactly the way you would normally invest?
Yes, that's a good question. You know, we already are very strong in our unlisted property fund business, so that's a very mature business. It was already managing over $1 billion worth of commercial assets throughout Australia. We have one REIT, or Real Estate Investment Trust, in the metropolitan office space. So where the 360 Capital property platform really suited us is the majority of their funds under management were in another two real estate investment trusts. So bringing them together meant our total funds under management swelled from about, I think, 1.9 to 2.9 overnight.
It's quite a growth spurt.
Yes, yeah, no, it's been assimilated very well in the company. One of the real estate investment trusts is an industrial trust. It's now called Centuria Industrial REIT.
And what sort of properties is that focused on?
Mostly it's a pure rent collector, so it doesn't undertake any development. So it's a pure play REIT with about $900 million worth of normal fit-for-purpose warehouses that you'd see right through the country.
Right. And so there's no geographical specificity in terms of where the locations are?
No, it's very well spread, and that's actually what you want with one of these listed vehicles.
So you're in a great position to be able to provide a view on what's happening in all manner of property segments. How are you seeing things at the moment?
Well, we don't commentate too much on the residential section,
No, of course,
which is very hot. But look, I think we have experienced a terrific surge in interest from offshore parties wanting to buy commercial and industrial real estate in Australia. It's certainly kept prices up, so the combined effects of all that interest and relatively low or benign interest rates has meant that the market for commercial and industrial property has been extremely buoyant. It's relatively difficult to acquire new assets, and one of our biggest challenges isn't actually to raise the equity or the debt, it's to make sure that we put quality property into these portfolios. So far this financial year, or the first half of FY17, we've bought just over $300 million worth of real estate, and we'll probably buy another $170 million between now and the end of this financial year with things that we've isolated and have under negotiation.
Okay, so we've heard from the RBA governor in recent times talking about almost a reluctance to be cutting rates from these levels. Do you get a sense that the interest rate cycle is in the process of bottoming out?
Yeah, I do. I think our internal view is that there's not much bias for downwards movement in interest rates. However, by the same token, when we look at what's happening globally, we find it hard to believe there's too much upward tension too.
Yep.
So what we call the window, if you like, of opportunity, where we can put quality real estate products together and still give our investor list 250, 350 basis point premium over fixed interest rates. That window's pretty firmly open, and we see it being open for at least a couple of years.
Okay, so having just completed such a massive acquisition. What are going to be the priorities as far as the next 12 months are concerned?
Well, firstly, the process of bedding it all down has been, almost complete. We'll certainly have that complete in the next 30 days. For the rest of FY17, we've got to complete a few acquisitions and fund them. That's looking very, very good. I'm very confident on our guidance for our earnings going into the second half of FY17. We've given guidance of just under 15 million of operating NPAT. We had an interim dividend of 2.3 cents. There'll be a final dividend of 5.2 cents. All very confident about. Looking further forward, I think we've got 3 fantastic real estate platforms to grow. So each of the REITs can buy properties in their own right. And the unlisted property division, it can create further acquisitions also. We've launched a brand new product yesterday, which is an open-ended unlisted fund, and we're expecting that'll be very popular with the wider financial planning community and also our direct investors.
John, it's been a pleasure talking to you. Thanks for your time.
Thank you, Tom.
And thanks for joining us for the Executive Series.